Timing is as important as selection when selling options. Our strategy has a consistent pattern of timing from week to week, but sometimes financial events can determine when we trade. My trading week begins a half hour before the market opens Monday morning. Here on the West Coast, that's too damn early o'clock. As I wait for the market to open, I review the information I've gathered and armed myself with over the weekend, a process we cover in our episode about organization. Options prices have not yet settled, and you're more likely to get good price improvement or find anomalies. Also, starting first thing Monday morning means more time until expiration on Friday, and so you're more likely, on average over many trades, to get the best price for that week. Every second counts with time decaying. After the initial excitement of Monday morning, and possibly a nap, and through the trading week until Friday, I adjust my current positions and focus on daily options. If I'm able to close a position I've opened up on a high-priced stock for a penny per share, I do it, freeing more money for daily trades in the frenzy of trading before the Friday market close. Each day, Monday through Thursday, between the market close and the close of trading for a few ETFs 15 minutes later, I use some leverage to sell daily puts expiring at the end of that 15 minutes. Be careful here, of course. I don't ever like to be stuck owning a leveraged investment overnight. By Friday midday trading, I still have many of the put positions I set up early Monday, but I've bought back the puts for high-priced stocks and my daily options have all expired. I freed up investment capital and I go shopping. Even with so little time before expiration, plenty of good opportunities are out there. Go through your watch list, stock by stock, and look for good deals. I almost always find enough to use up all my funds. Often you'll find puts selling at strike prices several notches below the current price. That shouldn't be the case, but I don't complain. I always save some investment capital for 3:55 p.m. or 12:55 p.m. Pacific time where I am. You can still find deals that late. Sometimes even with seconds to go until expiration, you can find puts to sell at a strike price comfortably below the current price. Be ready to take advantage of price anomalies at this peak moment of options market messiness. I like to trade options on a stock immediately after an earnings announcement, when company-specific shocks are least likely to come. All the important news for that company at that moment comes out at the announcement. There won't be a CEO replaced later that week, new debt won't be issued, and surprise earnings warnings, etc. won't jolt the stock. I try to trade at the first opportunity following an earnings announcement, literally moments after options prices have been updated when the market opens and trading is ready to go. Some option chains reset quicker in the morning than others. Unusually high volume for a particular option causes a pause. Stagnant pricing will pop up and you have no way of knowing when the current prices will be posted. It's frustrating when you really want to trade options on the stock, and every time you check on it, you're passing up an opportunity to trade something else quickly. Yes, it's just a wait of seconds, a couple minutes at most, but each second is important, and when you're looking at one stagnant chain, you're missing the opportunity to look at an active one. Pricing for a post-earnings option is typically the best it ever gets that morning. Of course, options prices the day before the announcement reflect the likelihood of change following good news or bad news from the announcement. The risk pricing lingers for a bit Monday morning. In pre-market trading, the underlying stock already finds a price close to what it will trade at in the minutes after the market opens. Rarely are there big surprises, and you can sell puts with some confidence based on the pre-market price. However, enough anxiety about the price remains that you can still sell puts at strike prices well below the current price. In the seconds following the market open, you will see priced bid-ask spreads disappearing from the option chain, starting with the strike prices furthest from the current price. That's why seconds matter. So, how do I play the situation? As soon as the current prices pop up for a chain, I look at the strike price with a bid furthest below the current price, and I take it if it's appealing. I should say that's only if the earnings announcement has pushed the stock price up. If the stock post-earnings is falling, I wait until the dust settles and the price plateaus. When I sell a put on a rising stock following earnings, I often get such a good deal that I can buy back the put minutes later for a healthy profit. But the price you can get 5 seconds after the option chain updates will likely go away in the next seconds. That's why I decide which option chains to open tabs for and in what order ahead of time. We will have more to say about that in the organization episode. A word of caution. Sometimes it takes a few hours for the news to be digested and for the market to reach a verdict on the stock, even if the earnings announcement came out the prior afternoon. But by then, the good prices are gone. It's worth the risk in the long run to trade early. Another word of caution. Don't set pre-market limit orders for put sales on new positions. They usually don't go through at a price I like, and because I've already set up a trade for that security, and I don't want to risk a double position, I wouldn't be able to sell puts in that option chain when the market opens. An exception would be if that trade is not one of your top opportunities for the day, and you likely won't get to it until the market settles and the lingering risk pricing has gone away. Let me repeat that. As a rule, if the underlying stock price is up pre-market, trade it right away. If the stock price is down pre-market, wait until it settles down. It often tumbles further, and you don't want to see the current price fall to your strike price and your put options, a short position, rise in price. Yes, other news can have similar lingering risk pricing. Take advantage of news whenever it happens. The best example is a Fed rate decision, which always comes in the early afternoon of the trading day. You know it's coming, everyone does, and how the market will react to it is pretty well known. The exact wording of the announcement isn't known, but that's good. It helps to make the risk pricing available a little bit longer. In the moments after the announcement, I'll sell puts in index ETFs, and I've got the tabs for my option chains already open and my finger on the trigger. At the time of this recording, we have recently had market jolts from midday tariff announcements and war news. We don't know when they're coming, but you should have a plan of action when they do. I immediately look to my watch list for index ETFs. To understand how to react to surprises from individual companies, you can go further. Check chat sites, with skepticism, of course, in the text of a company's press release or live appearance. You can't really prepare ahead of time. The top financial analysts for a company may not be surprised when the news comes, but even for them, the timing is unknown. What ties all these situations together is the need to be as prepared as possible so that news doesn't disorient you in the seconds that matter. With our strategy, you will be able to focus while others are distracted by irrelevant information and market noise. Make sure you subscribe so you don't miss the many more options trading tips to come.